A new stimulus package called the Consolidated Appropriations Act was agreed upon by Congress and signed into place by President Donald Trump on December 27, 2020. This is a $2.3 trillion spending bill with $900 billion towards stimulus relief. Now, while there's a lot in this bill for businesses, individuals, and families, the video today is really going to focus on the relief for families and individuals. First, we're going to walk through the financial aspects, then the tax aspects, and stick around to the end where we're going to talk about some long-term planning and tax strategies that you may want to think about for your plan based on this bill. I'm Scott with Sierens Financial Group, where we help people with their key questions. Are you on track for retirement? What can you do to help improve your financial picture? And what can you do to potentially reduce your tax situation? The Consolidated Appropriations Act of 2021 has a lot of parts, from stimulus checks to unemployment updates to FSA funds and then tax relief. Also, as I mentioned earlier, this is a $2.3 trillion spending bill. Add to that the $2.2 trillion CARES Act, and well, that's a lot of national debt. So at the end, I'm going to talk about some long-term planning and tax strategies that you may wish to consider, especially if you feel that taxes might be going up in the future. But first, let's dive into an overview of the bill. I've used multiple sources to provide you this information today. So at the end of this video, there's a page with links to all of the different sources. Also, there's links in the description below. Let's start by talking about the financial aspects of this stimulus package, and we'll start with unemployment benefits. Now, unemployment benefits are to be extended for 11 weeks. That would take unemployment benefits out to about mid-March. Also, it creates another bump or increase in unemployment benefits of $300 also for 11 weeks, meaning individuals will receive an additional $300 on top of their regular state-determined unemployment benefit. Now, remember, unemployment benefits do add to your taxable income. Next, this bill also rolls out another round of stimulus checks. As of this recording, the amount of the stimulus checks would be $600 per eligible individual taxpayer and $600 per child under the age of 17. This is supposed to be based on your 2019 adjusted gross income. And then this also has a phase out similar to the last round of stimulus checks. The phase out starts at $75,000 for individual filers and then $150,000 for joint filers. The phase out is a $5 reduction for every $100 of adjusted gross income that is in excess or over the phase out amount. The third financial aspect is being able to carry forward funds from your flexible spending account. Now, depending on your employer, you might have a flexible spending account, or what sometimes known as an FSA. These are funds that you've put aside that are used for health and medical expenses throughout the year, and typically these types of accounts are use it or lose it types of accounts, meaning any unused funds are forfeited at the end of the year. Well, with the Consolidated Appropriations Act, this bill gives employers the option to allow employees to roll over funds into the following year. It could be up to $500, or any remaining funds that you do have in your account must be spent within the first 2.5 months of the following year. Now, this could be for 2020 rolling over to 2021. Also, 2021 rolling over to 2022. However, this relief appears to be solely up to your employer. Before I get into the tax updates, I hope you're finding value in this video, and if so, and you'd like to see additional videos just like this to help you build wealth and reduce your overall tax picture, subscribe to our YouTube channel. You can subscribe to our channel by hitting the red subscribe button below this video. Also, there's no cost to you to subscribe to our channel. That way you'll get notified as we're continuously coming out with new videos to help you in your financial future. Next, there are multiple changes to the Internal Revenue Code. Now, again, with a focus on families and individuals, let's talk about some of the tax updates. Okay, the first tax update. In August, President Trump signed an order allowing individuals to defer their share of Social Security taxes. This would help increase cash flow in the short term, but it did have to be paid back between January 1st and April 30th of 2021. Well, this act continues to defer the payback, so it extends the payback to a period from now and until December 31st of 2021. So if you are someone that did defer your Social Security taxes in 2020, they do have to be paid back, but now you just have a longer time frame to pay them back. The second tax update is for those that itemize their taxes and have medical costs, or for those that have a lot of medical costs and are really close to itemizing your taxes. This bill or relief package has set for all taxpayers for all foreseeable future years that any medical costs that exceed 7.5% of your adjusted gross income are deductible. For example, if your adjusted gross income is $100,000, 7.5% of that would be $7,500. So let's just say you had medical cost of $10,000. Well, it's the amount that exceeds the $7,500, so $2,500 would therefore be deductible on your taxes. This 7.5% rate has fluctuated in the past, but now seems that, or appears to be set for the foreseeable future. Well, or until Congress meets again and decides to change it. The third tax update is to help offset the rising cost of college tuition. 2020 will be the last year for the tuition and related expenses deduction. Replacing it will be the lifetime learning credit with a higher phase-out range. This credit reduces your tax bill on a dollar-for-dollar basis for a portion of the tuition, fees, and other qualifying expenses that you pay for yourself, a spouse, or a dependent to enroll in school. The fourth tax update is for those that take the standard deduction, meaning you do not itemize your taxes. And this is an above-the-line deduction, meaning in addition to the standard deduction for cash contributions made to charitable organizations. While this used to be $300 per single or joint tax filers, the bill has now updated this to $300 per individual taxpayer, meaning for individuals, you can get this additional deduction of $300, or for joint filers, you could get a deduction of up to $600, again, for cash contributions made to charitable organizations. This is not only, this bill not only puts this into place for year 2020, but also puts it into place for year 2021. Our fifth tax update is a charitable extension into the year 2021, allowing you to deduct up to 100% of your adjusted gross income as a qualified contribution when making a all-cash contribution to a charitable organization. Our sixth tax update is for those that claim the Earned Income Tax Credit or the Additional Child Tax Credit. Now, while 2020 might have thrown your earned income way off, this bill allows you to use your 2019 earned income to calculate the amount that you'll receive for credits in 2020. Last, let's talk about long-term tax planning and tax strategies. As I mentioned in the beginning of this video, the national debt continues to go up. In 2020, over $4.5 trillion in stimulus and spending packages. So like me, you may be worried about taxes potentially going up in the future to cover all of this national debt. If you don't have a tax plan and long-term tax strategy in place, now is the time to get serious about it. Here are some areas to consider. First, are you putting your money into the right tax account types, meaning your 401k or a Roth 401k or an IRA or a Roth IRA, meaning are you going to pay taxes on it in the future, or are you going to be able to withdraw it tax-free in the future? Second, do you have the right types of investments in the right tax account types, meaning are your investments causing you additional income tax? Third, have you considered repositioning money between tax buckets, meaning paying tax today at a known rate and having tax-free growth and tax-free withdrawals in your future? To help with this, in the first consideration that I mentioned, take a look at our video 401k versus Roth 401k and which may be better for you. There's a link above in this video as well as below in the description. If you're worried about taxes potentially going up in the future, well, you're not alone. If you don't have a long-term tax plan in place, you should definitely consider it as national debt continues to rise. If you're wondering where to start, utilize our website to set up a 15-minute complimentary call, and we can review your situation and which strategies may be a fit for you. Also, if you found value in this video, subscribe to our YouTube channel as we're continuously coming out with additional videos to help you build wealth and reduce your overall tax picture. Thanks, and have a great day.